Good morning, everyone. You are watching a live market outlook for Thursday, 26th of January 2012, prepared by Windsor Brokers. The markets appreciated yesterday's Fed's decision to keep the ultra-low rates low for the longer period of time, and euro, commodities, and equities extended gains yesterday after U.S. Federal Reserve said that would likely keep interest rates low for a much longer than expected period, and providing ample liquidity to help spur growth. The prospect for unfavorable interest rate differentials undermined the dollar, pushing it to a 5-week low against the euro as the U.S. Central Bank took the spotlight away from the Europe's debt crisis. The Asia-Pacific broadest index MSCI shares outside Japan rose to its highest in nearly 3 months and was up 1.1%. Hong Kong shares also resumed trading after a 3-day Lunar New Year holiday and outperformed the Asian peers on fresh buying in commodities related stocks, rising by 1.4%. Gold also rallied higher on the weaker dollar, hitting levels above $1,700. That was our initial target, and adding gains to Wednesday's 2.5% gains. We're now currently holding above $1,700 an ounce. The comments from the analyst say that Bernanke's comments delivered the strongest message yet to highlight the fundamental factor supporting gold's rally over the past decade, which is that bullion's value is enhanced as currency's value depreciates when lots of money is printed. The euro rose to its 5-week high around 131.27 during the Asian session, while the dollar yen dipped to below the initial support at 77.60 after hitting a fresh 2-month low yesterday near at 78.27. The dollar index measured against the key currencies hovered the near 5-week lows below 80. That was the brief outlook of the headlines of past 24 hours. Now we're going to take a look on today's calendar, which is also showing quite busy, especially in the Americas. CBI realized sales from UK are due at 11 o'clock GMT, and -2 today's forecast versus +9 in the previous release. And that was except German GfK consumer climate that was released earlier this morning and came in better than expected and better than previous month release at 5.9, while forecast was 5.6 and the previous release at 5.7, and that was all from the European side. Across the ocean, U.S. unemployment weekly unemployment claims are due at 13:30, and increase to 371,000 expected today compared to 352,000 claims of the previous week release. Durables goods orders monthly release at the same time, 2.1% raise is forecasted for today compared to +3.7 of the previous month release, while core durable goods orders are expected to grow by 0.9% versus 0.3% of the previous month release. New home sales from US are due at 1500 GMT, and the further raise is forecasted for today. 321,000 is today's consensus compared to 315,000 of the previous month release. At the same time, US CB leading index monthly release 0.7 is today's forecast. Later in the close to the end of the US session, the trade balance from New Zealand showing a forecast is showing a narrowing of the gap to minus 47 million New Zealand dollars compared to minus 308 million New Zealand dollars previous month gap. That was all from today's events. Now let's take a look on the technical part and see the latest movements in the markets. As usual, starting with euro, the single currency against dollar ended its 2 days congestion under 130.50.60 previous high, where the dips were contained just below initial support at 129.50. A dip to 129.30 was seen before the finding footstep, and the fresh rally was accelerated after FOMC's extremely dollar negative release that pushed the euro through the previous through the next barrier at 130.75, 131, to end so far at 131.32. It's also testing the 55 days moving average on the daily chart. The prospect for further gains exists despite the overextended hourly studies that suggest some corrective action preceding a further rally, with 130.60, 130.50 previous highs now acting as initial support, and before this dynamic support at 130.73. Currently it's 20 days moving average, with dips expected to be contained above 130 to maintain the current positive structure and resume against higher. Also significant on the daily chart is that fresh momentum is now emerging above the center line, as well as MACD that is attempting to break higher, as the pair was boosted initially by breaking above daily 20 days moving average, would break above 55 days moving average to resume gains towards 131.45, which is our next significant target, 4th of October 2011 low, above which to open next levels at 132 and 132.11, the low of 25th of November 2011. Overall, outlook for euro dollar remains positive in the short term, as the pair remains in a steady uptrend for nearly 2 weeks from 126.22 low, with the latest clearance of strong resistance at 130.75 and 131.00, opening way for a further extension higher. Also above 132, the next Fibonacci level lies at 132.36, which is 38.2 Fibonacci retracement of broader downtrend from 142.46 end of October peak down to 126.22 mid-January low posted on 13th of January. Cable is also in the strong uptrend after ending corrective phase after the pair failed to sustain gains above 156, stalling at 156.27, and subsequent pullback found ground at 155.30, just ahead of 155.15 and 155.00, our key short-term support, where also comes the main bull trend line drawn of 152.33, 52.33 low. Break above 156 is now attempting at 157, our next barrier. The clearance of strong resistance zone at 156.60.70, where we have the 3rd and 4th of January highs at 156.68. Also 90 days moving average, and the main bear trend line drawn of 166.17 high of 19th of August 2011 now opens way for a further extension higher, breakthrough 157 to open next strong barrier at 157.70 zone. This is the range of end of November to end of December. It's the ceiling of the end of November to end of December range, with several attempts, actually 3 attempts at this point failed to break higher. Now the market is likely going to challenge this level again. Also on the daily, we can see that momentum and MACD are breaking through the center lines. That gives additional boost as the pair broke above three important moving averages, 20, 55, and 90 days, and also broke above the main trend line. Break above 57.70 congestion is likely to open further extension higher, with Fibonacci level 61.8% to come next at 158 zone. Dollar yen lost traction after a strong 2 days rally from 76.85 higher base, resulted in testing of a strong resistance zone at 78.20.30. This is the previous range ceiling from the end of November to end of December. However, the positive structure on the wider picture remains still in play as the pair dipped to its initial support, broken trend line, broken main bear trend line, dipping so far to 77.50 zone, where the currently is attempting to build the base. This is important as the pair found so far the footstep just above a strong support zone at 77.40, which marks 61.8 Fibonacci retracement of the latest rally from 76.85 to 78.27, and the previous strong resistance zone now reverted to support at 78.20.30, where gains were initially capped. We can see it better on the daily chart. So this is the zone, and reversal above this zone is required to maintain the near-term bullish structure from 76.85 for possible fresh attempt higher. However, negative release of the FOMC that pushed the dollar lower keeps the near-term outlook still in the negative field, with break above minimum 77.80, 78.00 required to improve the current negative structure as shown on the hourly chart, and refocus levels at 78.20.30, our key barrier, above which to open next levels at 79.00 and 79.52. This is the post-intervention in the end of October spike high. On the downside, loss of 77.40.30 support zone would risk return back to the previous range of 76.85 to 77.32. Dollar Swiss is again in defense after a near-term past 2 days consolidative corrective attempt of fresh low at 92, previous fresh low at 92.33, posted on 24th of January, and break above initial barrier at 93.00, stalled at 93.38, just ahead of our next strong resistance at 93.76, regain of which was required. This is the lower top of 23rd of January, regain of which was required to ease the bear pressure and open way for stronger recovery. However, the likely scenario, as mentioned in our analysis yesterday, was lower top under 93.76, and the fresh weakness that exactly happened. The pair surged lower after losing 92.50 and 92.33 supports, also breaking below our next target at 92.00. That is 38.2 Fibonacci retracement of 85.66 to 95.93, pardon, losing also 55 days moving average earlier. And now target is 90 days moving average that the pair currently approaching at 91.78, ahead of next static levels at 90, exactly at 90.75. That marks 50% Fibonacci retracement, and the low of 30th of November 2011 at 90.64. That would be our next target. With loss of 90 level to be quite risky for the further developments, as it might signal a break in the uptrend from August 2011 and allow for a stronger correction that might test levels into 87 and 85 zone in case of loss of 90 barrier that was a couple of months ago stronger resistance, now reverted to support. The daily outlook is weakening now, as we can see that all studies are pointing lower and breaking below their center lines, with loss of 90 days moving average to further weaken the structure and the open levels previously mentioned. On the near term, 1 and 4 hour studies are negative, but overextended conditions suggest some corrective action before fresh weakness takes over. 92.33 and 92.50 are our initial resistances, along with 92.37 currently the hourly 20 days moving average, and this is and the 4 hour 20 days moving average at 92.74. that is expected to limit the upside for now, where the reversal is anticipated just under this level to resume the short-term downtrend from 96.00, 95.73 strong resistance zone. Commodities, the gold is shining again after a period of consolidation where the gold was unable to clearly break a strong resistance zone at 1670.80, where was 90 and 55 days moving, were 90 and 55 days moving averages, also the main bear trend line drawn of a record high at 1920. A final surge through this level opened way for a stronger recovery as the weaker dollar supported the yellow metal. 1700, our initial barrier was regained. 1712, 1714 actually seen so far, and opens way for a further extension higher. We can see that daily studies are improving now and opening and giving signals of further extension higher. 50% Fibonacci retracement level at 1721 comes next. This is the retracement of the broader downtrend from 920 to 1522, which gold would likely claim next levels at 1756 and 1763, highs of 2nd and 8th of December 2011, ahead of Fibonacci 61.8% at 1767. On the downside, now initial support comes at the previous high at around 1681, with the broken trend line at 1666. 4 hour 20 days moving average comes above this at 1678, currently maintaining the uptrend, and I would say ideally reversal around 1680 would be the best to resume the gains higher. However, further reversal down to 1666 is important to hold above 1650 strong support zone to maintain the current positive structure intact. The crude oil also bounced strongly higher on a weaker dollar yesterday, after dipping just close to the previous low at 97.43. 97.53 was seen ahead of a strong rally. A break above 20 days moving average and a regain of previous highs and strong resistance at 122, with the 137 seen so far, keeps the prospect for a further extension higher. However, the correction on overbought hourly studies is now underway. I would say that holding above 99 zone would keep the positive structure in play, while a loss of 99, where is 99.22, 99, where 20 days moving average would signal exhaustion at levels above 100, and possible return lower, as there was no clear break above this previous high. The risk remains slightly to the downside as resumption of the downtrend from 103.72. I would say at this point regain of a minimum 101 is required to ease the immediate bear pressure and open way for a stronger recovery. Otherwise, we might see the resumption of the downtrend from 103.72 and possible retest of the now higher base at 97.43.53 ahead of possible further extension higher. So far, the NYMEX crude oil was not that much affected from the current crisis with Iran, as still it's all the movements are still in the rhetoric way, but most likely any military action, which we wish not to happen, might affect the oil price stronger and push the prices significantly higher.